Tesla's up huge today, growing like crazy. It's insane. That's just the spark in the room that caused the explosion. Now it's rebounding. We're excited when a stock falls in price. All right, guys, if you're new to the channel, we're talking about Tesla today. It's really, really important you subscribe. We're going to do a lot of videos, I'm sure, in the next 2 years on Tesla. And the reason being is, unlike the other hypesters over the last few years, we're excited when a stock falls in price. Now, if you're new and that confuses you, I want things to be cheaper. I like the sweater. If all of a sudden the sweater went on sale for 70% off, I'd probably buy way more than I need, just in case one gets ruined and I have to buy. Whatever it is, I like buying things that I love at a cheaper price. Tesla's a great car company, massively profitable and getting better and growing like crazy. But the difference between us and all those other hypesters is we look at the fundamentals of the business. We realize that buying a stock is buying a piece of a business. We don't care about where the stock price is going. What we care about is the price in line or better than the value of the company? So price and value are right here. We want to buy when it's like this, when price is below value. But the way Tesla's been in the last few years is like this. We always said, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. What that means is, in the short run, the popular stocks will go up, the unpopular ones will go down. People will bid the ones that are very popular up and go down. But in the long run, the fundamentals of the business will be what matters. How's their revenue and cash flow? How's their balance sheet? Most importantly, what's the multiple you're paying for those? So, what's a reasonable price for Tesla? Let's go check it out. So first off, Tesla's up huge today. It is 11:05 a.m. Eastern Time, January 9th. And the stock is currently up 7.7%. The 52-week low, it recently hit a low of 101.82. And the all-time high was November 4th, 2021 at 414 stock price. That's 14 months ago. It's fallen over 75% to its low. Now it's rebounding. So the question is that a reasonable price? Well, let's go check out some things first. Let's look at our 8 pillars here. A lot of X's here. A really high 5-year PE, a really high 5-year price to free cash flow, increasing shares outstanding. Guys, this is important. If you're new to the channel, this is the silent killer of investing. When companies are very expensive, companies will issue shares to investors saying, listen, we need to raise capital. Instead of taking on debt, let's just issue shares that are massively overpriced to the market. That's what they're doing here. But they're diluting the owners already there. That's the problem. Diluting owners. They're making more and more partners for you, and they're giving you less and less revenue and profit as a percentage of the company. That's the problem. And the other thing is a low return on invested capital. This one doesn't worry me as much. It's a 5-year return on invested capital based on some metrics, but as the company gets better and better, their profit and cash flow will increase and their ROIC should get higher. Now, one thing I don't like about Tesla is the industry it's in. It's a sucky industry. The car industry sucks. It's got high labor costs, there's unions, these things like that. And I don't care about your political affiliation. I'm just not a fan of those. So the question is, can we still buy this for a reasonable price? Well, let's see some other metrics in the company. Let's look at their income statement. I mean, look at this revenue growth, guys. It's insane. Look at this over the last 10 years. Huge revenue growth. And cars are about 88% of their revenue right now, but they have other sources of revenue. Will those work out? I don't know. I'm buying the car company because it is a car company. When 88% of your revenue comes from selling cars, you are a car company. Now you might sit there and say it's data. You might listen to, what's his name? Kevin O'Leary when he says, oh, I thought Tesla's overpriced, and somebody said, no, you don't get it. They're a data company. Well, cool. He also likes crypto and FTX, so he's an idiot. Now, let's look at the profit down here. They were losing money like crazy, and then they turned that around. Boom, $11 billion in profit in the last 12 months. Is that going to continue? I don't know. But what I'm waiting for is the right price to pay for a great company. Few other things I want to look at here. Gross margin and profit margin. Their gross margin is 27%, which is high for a car business. So the reason I'm already kind of a little timid is I'm asking, is this sustainable? I don't know. Because a lot of this has to do with credits and things like that. Look at this profit margin. In the last year, it was 15%. Last 5 years, 6.6%. Is that 15% sustainable? I don't know. This is where the research comes. And guess what? There's a lot of people. We have thousands of people in this community. And there's a lot who love Tesla, who've done a lot of research. So join the community so you can do your research on this company. So go to everythingmoney.com and check it out. Now, The question is, what's a reasonable price to pay for Tesla? Now, we have our stock analyzer tool. And the reason this is beneficial, it allows you to look at a company and say, hey, when I buy an investment, I'm buying a stream of future cash flow. That could be negative to start and then grow to profitability. It could be zero for a long time and there's an exit. But usually with companies, you're buying some sort of cash flow along the way. And when you present value those all today, that's your return. So if I told you I was going to pay you $1 a year for the rest of your life, what's that worth to you today? I don't know. You have to figure that out. There's a lot of unknowns there. That's the thing about companies. We don't know the future. 3 years ago, if I told you that Elon Musk would buy Twitter, what would you have said to me? Now, people are blaming the stock fall because of Elon Musk buying Twitter. I look at it saying, that's just the spark in the room that caused the explosion. Guys, we don't know what's going to happen in the future on anything. That's why you have to have that margin of safety. That's why you can't buy a stock and buy a business based on all the rosiest of rosy assumptions. Remember, we're in an economic boom still. We have very low unemployment, but there's a lot of headwinds with the economy. We don't know where it's going to go. And guess what's going to happen? If the economy goes into a recession that's a little bit prolonged, where are car sales going to go? We just came off a boom on car sales. I'm already seeing it decline. I literally had a car I was selling. I was selling a luxury car to a dealership. I got an offer of X. I said, no, I think I can get more. A month and a half later, I sold it for 25% less than that first offer. The market shifted. Okay. And that's what's happening. These things do happen. That's the issue with companies. You don't know what's going to happen in the future. That's why you need that margin of safety to be able to buy companies, factoring the unknowns that you don't know. So let's go see what we think Tesla could be worth in the next 5-10 years. Let's look at analyst estimates in our software. Analysts expect revenue to basically double in the next 3 years. Profit to double, and revenue to go from $118 billion in 2023 to $210 billion. So still some ample revenue growth and some profit growth. So that's only 3 years though. I'm trying to do a 10-year analysis on the company because I want companies I can own for a long period of time. So I'm going to make some conservative assumptions. I'm going to go with, remember this is 10 years of growth, not just 2 years or 3 years. I'm going to go with 10, 15, and 20% revenue growth over the next 10 years, which is still ample, not amazing on the 10% level, but still allows the company to go and keep growing and become one of the biggest manufacturers of cars in the world. Because I think they did 1.4 million cars last year, which is amazing growth. And they can still, at 10% growth a year, they would still be doing around 3 million cars a year. That's pretty solid. Profit margin. Now I'm going to ignore this 10-year number because I look at the 10-year number going, that's probably pretty low. They've done pretty well. But this 1-year number, is that reasonable? I don't know. So I'm going to sit here and go 8, 12, and 16% profit margin. I'm doing a low number saying 8's probably low, 16's probably really high, and 12's probably somewhere in the middle. Okay, let's go with that. Free cash flow, I'm gonna do the exact same thing. Now PE. Guys, the company is currently a 34 PE on the 1-year level and a 43 price of free cash flow on the 1-year level. You saw the 5-year numbers were triple digits. So imagine what it was when it was $400 a share. It was hundreds and hundreds of PE and price of free cash over the last 5 years. And it was 150 on the 1 year and PE and price of free cash flow. But remember, it's still, the average company is still 15. The average PE over long periods of time is 15. But this is a great company. I'm gonna go 15, 16 and a half, and 18. Now, just because I do think there's a lot of potential for Tesla, even in 10 years, if they grew at these numbers. Now, desired return. Guys, this is what do you want to make? What's your hurdle rate? You can get 10%, 9 or 10% in the long run by investing in an ETF. So what's your return that you want for investing in an individual company? Well, I would sit there and put 12, 14, and 16. As my assumptions become higher, I want to make my desired return higher. Now, I'm hit the analyze button. 6 numbers going to pop up. The stock is currently at 122. So look, if you believe these highest assumptions, it looks like the stock's a buy. That doesn't mean you go buy the company. Go do your research, join the community, talk to people who've read the 10K. Go understand if these assumptions are reasonable, okay? On the low side though, it's only a $37 company. Somewhere in the middle is probably more accurate. Is it 73? I don't know. I have it at 60 on my watch list. Why 60? Well, I'm not saying I'm buying it at 60. I'm probably going to sell puts at lower prices because even 15% revenue growth for the next 10 years, what does that make it? 1.15 to the 10th. I think they did 87 billion last year. It's still $351 billion in revenue. It's not unreasonable, but guys, there's a lot of hurdles they have to come with. They have to get production hurdles out of the way. They're still growing like crazy, building factories. There's a lot of issues, and the competition is starting to increase. You're starting to hear a lot more about these other companies selling a lot more electric vehicles. Does that mean Tesla's not going to be number one? No, I still think they could be the number one electric manufacturer, but as the pie grows bigger and bigger, other companies are going to enter and fill that space. So when the stock was at 414, was I in love with it? No, even on the highest assumption, it didn't make sense. And go look at our past videos, guys. We were saying this even though everybody was taking a dump on our chests, telling you guys are stupid, you don't get it. I got in a little YouTube battle with Meet Kevin about it because he was assuming 70 PE on the company in the future. That's because he's an idiot. No company that's so big should be a 70 PE. It's just hard to grow when you're that large. Now, Tesla still has a lot of growth potential, but it's not a shoo-in for that. You've got to remember that. That's the key here. So guys, if you like this, two things. Subscribe to the channel. If you like our software, we have a risk-free guarantee. Go to everythingmoney.com, sign up. If you don't like it within a month, email us and you'll get your money back, no questions asked. Thank you for your time.